invite Toti here. Let's tackle the questions. We have a lot of questions, but Toti, join us in this panel. Let's try to keep our answers short. We have a lot of questions here, but let me just start off. No, Toti, let me start with you. No, I don't know, but this might be a difficult question because consensus estimates for Ayala land, particularly, is like 17.3 billion this year. And pre-pandemic, you were 33 billion. When do we kind of expect this to come back to your pre-pandemic level as far as your income is concerned? Kaya?
As far as net income is concerned, Marvin, we've declared, or we've told our investors, our institutional investors, as well as some of the analysts. I mean, I think all the analysts who attended our briefings, based on what we're seeing and the way the economy has opened up, we think we'll get to pre-pandemic levels by 2024. Right? Mm-hmm. I think that's the general direction. But a lot of that is also premised on an economy that will continue to recover strongly. That's why I've always said real estate is a very localized business. We depend also on the country's economic growth. And for as long as the economy grows at least a 6 to 7% clip, then we should get back to pre-pandemic levels because that was also the growth clip that we were experiencing in the past decade. Right. So the fighting target is by 2024, which is 2 years from now. Mm-hmm. We said this, we mentioned this, or we made this declaration last year. We said 2 to 3 years. Mm-hmm. And we'll see. I think what's important for investors and analysts to track is the sequential growth of both our revenues and our bottom line. And the minute mobility came back, you saw it. The revenue started coming in.
That's right. That's right. I see a lot of growth coming in from the commercial and the leasing, and I'm really quite happy that despite your challenges in the residential side, which is the bulk of your earning, about half of your earnings, no? Is that any intentional way of moving your portfolio in a way that you can maximize earnings potential?
Yes, and that's why I also wanted to focus on our being a diversified real estate developer. If you will recall, let's step back to pre-pandemic. In 2014, we incepted the 20-20-40 plan, which was by the year 2020, half of our net income, or 20 billion, would come from the residential business. And the other half, the other 20 billion, would come from our leasing businesses. And that was a deliberate strategy to further balance our portfolio. Because our experience, and we had seen it in the past, the residential development business can be cyclical. And that leads to volatility.
Yeah.
Our experience was the leasing business, particularly the malls business, even through the various economic crises that the Philippines faced, as well as the political crisis, we only saw our leasing or our mall revenues go one way, which was constantly growing. So we incepted that strategy to have a more balanced portfolio, so that when you see the development side getting stressed or the cycle turning, then we would have the relatively stable and steady cash flows coming from the leasing businesses to underpin our economic performance. So that was the strategy, and we were executing. We significantly grew our gross leasing portfolio. If I recall, at that time, we had, since then, I think we've been able to close to triple our mall space. And our hotels probably just had 1,000 rooms. We've now quadrupled that. We're now the largest office landlord. Carol and her team have grown our office portfolio significantly. And that's now becoming or proving to have been the right strategy. Because the residential segment is experiencing its challenges today. Okay. But let me add some perspective to the residential market. Again, from someone who's lived through the 80s, to the political turmoil we saw then, the 90s when you had the Asian financial crisis. During those periods, the residential market went to zero. Okay. Today, we're not seeing that, which is proof that we have a stronger economy, political system is stable, and by and large, the population has wealth, has accumulated wealth. And that's why our estimate is today, the residential market is probably running at anywhere in between 60 to 70% of where it was at the peak in 2019. So my point is, the residential market today is in much more solid footing than where it was in the previous decades. And after a 2-year pandemic, I think it's remarkable that the residential segment is still at 60 to 70% of where it was during the peak. So rather than looking at and saying that the residential market is in dire straits, I don't think so. Not from where I sit, not from what I've seen. In terms of, if we put things in perspective, it's doing remarkably well.
Great.
But to expect it to get back to 2019 levels, I don't think you can see that just yet. We need to see the economic scarring that has occurred in the past 2 years to heal. We need to see the economy continuing to grow. And you have the additional challenge brought about by interest rates rising. That has a direct impact on the property sector. So we need to see interest rates also settling at a level. Today, I don't think we really have a feel of where it's going to go. The FX market is also a bit volatile because they're also waiting for interest rates levels to achieve some stability. So the residential market faces a lot of challenges, but by and large, I would say it's on much better footing today than it was in the past. And as long as the economy continues to grow, we'll see growth return to the residential market.
Great. Thanks for that, Toti. Our audience are not only stock investors, as you know, they are also real estate investors. And I'm sure a lot of our audience is very interested to understand, saan ba pupunta to? I mean, di ba, you say your challenges here, but interest rates have slightly gone down already, more particular in the 10-year bond. No? So, and it was at 7, now it's only below 6 na. Baka, are we seeing that? Are we okay na kaya itong residential? I mean, are we on our way back?
Well, again, on interest rates, I was just talking to a banker yesterday. I think they're waiting for what the Treasury will do. Well, first the BSP tomorrow. Is it tomorrow or on Thursday? They want to see a 50 basis points hike. Okay, so that the FX market can sort of settle down. But I think I told them for our business and for property investors, it's not the overnight rate that matters. It's the 5 and 10-year benchmarks. Right? Because we're long-term investors.
That's right.
And the feedback I'm getting is they're also watching what the Treasury will do because they know the government has a big funding requirement. And they want to see how the government attacks that, what kind of funding plan they have in place, and whether they're going to fund it in pesos or dollars. I think once they've gotten and sorted their funding requirements, similar to how Ayala Land did its largest placement in July. I guess the government has a big requirement. Once they've completed that, then the market will sort of stabilize. And I think at that point, the long end of the curve will also find its level.
Yeah, good. So something to look forward to, Toti. But before I move to Carol, let me just ask one last with you. There are a lot of talks. I hear that a large investor in Ayala Land has been unloading, and a foreigner at that, and it has been reduced by 9%. I understand among your foreign ownership. There has been some buyback of Ayala Corp of Ayala Land shares. Can you tell us more about it? Can you give us more color on what's happening?
Yeah, certainly. And I think it also addresses a couple of questions that the audience has on why Ayala Land's share price has been declining. And essentially, we've looked at the data, and it's primarily on account of foreign selling. In the past, Ayala Land's shareholder registry had about 39% foreign and 39% foreign and 61% local. And as you know, in a real estate company, foreigners can only own up to 40%. So we were almost at that limit, and that's why in 2012, just taking you back and providing the audience some history, Ayala Land actually issued preferred shares, convertible preferred shares, which were subscribed to primarily by our parent, Ayala Corp, which is a Philippine corporation, and primarily locals. And what that did was it increased the Filipino ownership. Because now you add the preferred shares plus the common shares, and you see how much Filipino ownership you have on both classes of shares. You also sum up how much foreign ownership you have in both class of shares. So effectively what that did was, in the overall ownership of Ayala Land, the foreign shareholdings went down to about 26%, if I'm not mistaken, which meant that they could then buy more of our common shares without breaching the overall
limit.
foreign
limit. Yeah.
Okay. So there was a time where foreigners were at 39% of our common shares. Today, that has come down to 29%. So 10% has left the country, left Ayala Land, and that selling pressure over the past year, and I would say it accelerated in the first quarter of this year, has put pressure on ALI's share price. And which has led basically, I think, explains the decline. Now, the underlying value of the company has not changed. And the value is calculated. We calculate the intrinsic value of the company, but analysts also calculate the net asset value of the company. And if you track all the analysts, in the past 2 years, that net asset value hasn't declined significantly. On the average, the adjustments have been maybe 3%, 3 to 5%. What it says is the intrinsic value of the company has held. It remains. Why then is the share price moving? There is I guess, a difference between the intrinsic value and the share price. And I will attribute that to the heavy volume of foreign selling that has occurred. The disclosure has come out. AC, our parent, has acquired a significant block.
Yes, right.
And I believe that large block is a foreign investor, and we'll get the statistics from the PSE. They will be releasing that. And so I believe that has now reduced that selling pressure. If I'm not mistaken, if in fact that came from one investor, then that block was basically taken up by AC. And rather than that, and what that has done is, rather than having this foreign investor having to sell every day on the market.
In the market.
Because, you know, the trading volumes now are quite small, are quite limited. If you were to just try to unload that on a daily basis, that would contribute to the pressure.
That's right. That's right.
Now,
So medyo nawala na kaya
I think that pressure has now been reduced. The past week, we've been seeing net foreign buying in ALI.
And today,
So
today it just jumped up. Today, I guess that shows you that the market is slowly realizing the value of Ayala land now, right?
We believe so. And, you know, we are not managing the company for quarterly results. We're managing the company for long-term growth. So we're not taking any shortcuts. If the share price does not reflect the fundamentals, then I think it just presents a terrific opportunity. Yeah. Which is what our parent took advantage of. It's also something we see at the company, and that's why we've also we bought back close to 1.5 billion worth this year. And so, you know, these are the anomalies that happen in the market, as you know.
Yeah, that's right.
And so,
I guess the shareholders will understand that, and gives us comfort that the parent is buying back the shares, and we're giving us support on the share price at least. Right.
Yeah, and your analysts continue to validate that the net asset value of the company is there. Right. It hasn't been reduced.
All right. Sige, salamat, Toti. Let me give floor naman to Carol. If you have some questions here before I give it to the audience. No, I think the nagging question I have is AREIT. AREIT, medyo your dividend yield is lowest among the rest. I mean, you know, it gives information to the public that maybe this is a quality company. That's why the yield is much lower than the rest. But what is really what makes you different from all the REITs? What is really an AREIT that the others are not showing?
Yes. Well, I think it's largely because they've seen that over time, we're not just delivering on the yield, but also on that regular growth. So as you can see in the dividends that I showed earlier, quarter on quarter, or even year on year, like versus last year, dividends this year, so far 10% higher versus last year. So for REITs, really the measure is not just the yield, but on total shareholder return, which is yield plus growth.
Yeah. So when in these asset infusions, has there been an instance where the old shareholders got diluted because you have some share swaps, and you know that has there been an instance where the shareholders were diluted as far as the earnings?
The property for share swap would result to an increased number of shares in the market. That's correct. But because of the income contribution of the new assets, even with the wider or a higher shareholder base, it's still accretive on a DPU basis to investors. So overall, despite that increase in the number of shares issued, it will still be accretive.
Okay, and then the future asset infusion, we would expect still some share swap arrangement with Ayala Land, and you can assure our investors that it will also be accretive.
We will make sure it's accretive.
Okay, that is what I want to hear.
But the REIT, as you know, it can grow either via equity or debt or a combination of both. But regardless, we will make sure whether it's debt funded or equity funded, we'll make sure that it's accretive to the REIT shareholder.
All right, galing. That's just what I want to hear. All right, so at this point, allow me to move on to the advanced questions. Toti, Carol, we have a lot of advanced questions. What we did is we grouped them together in categories so that we can take them up very quickly. So in the interest of time, may I just ask you to answer it very quickly so that we can tackle a lot more of them. So ladies, can we have the first group of questions? This is about the economy. Actually, it's about interest rates. So the question of Angelo, how has the BSP raising interest rates affected ALI and AREIT assets and properties? So did it affect? I guess it's more the income or on the sales, right, Toti?
Let me take a stab at that first. No? So for ALI, two constituencies that will be affected. I guess the first would be the company, because we borrow from both the debt capital markets and the bank. So interest rates will have moved up.
Right.
Fortunately, most of our portfolio is locked in, so we're able to manage the increase in rates. And I would say, by and large, because we have a thriving business, we will be able to easily accommodate debt at higher rates. We're big boys. So with a professionally managed debt portfolio and a strong balance sheet coupled with a healthy business, we will be able to accommodate higher interest rates if and as they come.
I guess the question is on the consumer side or your buyers.
That's the second constituency that I'm more concerned about. And it's the buyers of our residential product who require mortgages.
Yes.
Right. So we've seen we have about 12 partner mortgage banks. And I would say that they haven't really increased the mortgage rates in a significant fashion. The 5-year rate is still at, on the average, about 7%. The 10-year fixed rate is at 9%. And the 20-year fixed rate is at 10%. They haven't moved it up significantly. And that's, I suspect, because of two things. One is, at the current levels, there's still a significant credit spread versus the benchmark.
Right.
And secondly, what we've seen is our mortgage banks are aggressively growing their portfolios. They want to grow their mortgage portfolios because the risk, I guess they see that the risk return parameters or the risk return characteristics are quite good. And they want to grow the business. And so they haven't really raised mortgage rates.
Affordability, Toti, affordability. Were they able to bring it down?
Okay, that's the other point I want to make, which is we've modeled an increase of 200 basis points on mortgages. Okay, let's assume mortgage rates go up by 200 basis points. And so for every 1 million peso loan, your monthly amortization goes up by 1,000 pesos. Okay?
Oh, yeah.
So for a 5 million peso loan, if your mortgage rate goes up by 200 basis points, and it hasn't yet, you will be paying 5,000 pesos more per month.
Okay.
Affordability in the residential sector is primarily determined by how much you will pay every month. So individuals, especially buyers of our Avida and Amaya properties, because they will require mortgage facilities. Whereas the buyers of our Ayala Land Premier and to a certain extent our Alveo brands, they don't need a mortgage. They pay in cash. Right? So those that require a mortgage, if they experience an increase in interest rates, or if interest rates would move up, the increase for a 5 million peso mortgage loan in their monthly amortization would be 5,000 pesos only, which we think our market segment, say the Avida market segment, they will be able to service that. They can accommodate that increase.
Did you lengthen the term to bring down the
Good question. I only used a 10-year term. to calculate that amortization.
Yeah.
When in fact, most of the buyers probably ask for 15 or 20 years. So what we've seen and what's important in the mortgage market, it's not so much the interest rate that drives the affordability as it is the tenor. And for as long as the banks will extend 10, 15, or 20-year mortgages, I think our borrowers, the buyers of our product, will continue to find it affordable.
Yeah, great. So, sure, quickly lang, Carol, yung AREIT, I guess the dividend yield is, the share price was affected, no? Because of the interest rates.
Yes, I think across all, it was affected because obviously a lot of investors moved to the more fixed income instruments, but it sort of settled, at least as far as AREIT is concerned, it's sort of settled at a certain price level. Now, to this question on interest rates, particularly affecting, let's say, valuation of our commercial properties, we don't think the interest rates increasing would directly or significantly affect cap rates of the valuation of our commercial properties, because as Toti mentioned earlier, property values have actually held up despite this rising interest. And to that second question on how it will affect our income as far as AREIT is concerned, similar to ALI, we've also locked in our debt via 2-year fixed bond rate. So we don't see it, at least in the immediate term, affecting our income.
Are you also able to pass on the increase in interest rate or inflation to your tenants? Is there
that's correct? Yes, that's correct. For REITs, for leasing, the rise in interest rates should not really affect our operations because there's also contracted rental growth.
Escalation clauses. Yeah, great. All right, sige, thanks. Let's go to the next group of questions on offices. Question by Edward: how can you address the lower office utilization due to most companies offering work from home setup? Carol, maybe you can take this.
Okay, so I did present a few slides regarding this earlier, but just to add to that, in terms of BPOs, the companies, they are regulated by PEZA for their tax incentives. And the regulation of PEZA to avail of tax incentives for BPOs is to operate 70% on-site and 30% maximum from home. So we anticipate that this hybrid, sort of hybrid work arrangement will continue. But as I said earlier, BPOs continue to expand globally. Outsourcing, a lot of companies are operating under this outsourcing model. And the Philippines, the IBPAP, the industry organization, projects a BPO growth here of anywhere between 8 to 10% annually. And so despite the hybrid work, businesses expand, and the utilization of office space will require more space because they need it for more collaborative areas, interactive areas, flexible use of spaces. And so net-net, studies show that there's still anticipated net increase in office pickup. And that's what we've experienced. We've not really experienced significant downsizing as far as our BPO clients are concerned. Not significantly. What really drove down office vacancy was the flight of these POGOs sometime last year.
Wala na yung POGO. So now the reconfiguration of the offices, as you say, more flexible, people need to meet face-to-face still. Net, there's a growth still on demand for office leasing.
Yes, that's the study being shown by the industry.
Great. Sige, next group of questions. Let's look at ALI outlook. Why is ALI residential lagging in sales? You talked about this already, Toti. Let's look at the second one. Is there an excess supply of available office and residential spaces? Asked by Emil. Is there an excess supply?
I think in terms of industry of office vacancy rates, it's running at about 18%, 18 or 19%. So there is that vacancy. That vacancy is quite relatively high. On residential spaces, let me just cite some numbers. I mean, the housing backlog in the Philippines is about 6.5 million. But admittedly, bulk of that would be for the lower
Right.
end.
Right.
What we see is that for prime residential properties, there is no oversupply. And the reason we say that is because today, with what we've seen in the pandemic, you would expect massive. You'd expect people to be selling down their properties. We're not seeing that. As a matter of fact, for our prime residential developments, the secondary market is actually quite robust. I can give you an example. For example, let's look at two segments. One is the vertical and the horizontal. I think everybody knows the story in horizontal. They can't have enough of it. Yeah. And that's why we've had to reconfigure our launches this year. In the past, we would launch about 70% vertical, 30% horizontal. Today, we've reconfigured that to 50-50.
More on horizontal.
50% horizontal, 50% vertical. Yeah. Because there's such strong demand in horizontal. Yeah. Now, on the vertical side, if it's a prime condominium, it continues to sell well or to hold up. Secondary market, for example, I just looked at the suites. We started selling that at 180,000 pesos per square meter in 2013. Secondary market today is 500,000 or half a million.
So
those are transactions that are happening.
There isn't much panic selling, or there's none panic selling on that area.
For prime properties, absolutely not. And ALI itself, we were looking for good deals during the pandemic. We were looking for land. We thought there would be discounts to be had on land. There was not. Landowners know that this crisis will pass, and land will continue to appreciate. So they're just going to hold on.
Okay, sige, good. Next group. Thank you for that. Next group of questions, ladies. Do we still have asset infusion? What are the prospects of additional infusion of assets from ALI to AREIT? I guess you said that doubling, doubling. Are we expecting a doubling again for the next maybe couple of years?
You're coming already from a larger base, so I don't know about the second doubling. Okay, but
what is
next year definitely we expect the full year contribution of the Cebu assets, and as we have disclosed, I think once a year we disclose the company's 3-year investment strategy. We are projecting anywhere between 90 to 100,000 100,000 square meters of asset infusions into the REIT. Of course, this is dependent on market conditions, etc. And so far as AREIT has only about a third of the leasing portfolio of ALI, so we can expect still a pipeline from ALI to feed into the REIT.
So 100,000 per year, still the target asset infusion, more or less.
So far, that's what we've been doing from 2021 and this year again, 2020.
Still massive. So second question here by Agapito Toti. I guess if you're moving assets from ALI to AREIT, will that make ALI less attractive now? I think that's the question of Agapito here.
Well, this is part of our long-term strategy, which is to develop the assets at ALI and create value there. And once that particular leasing asset has been stabilized, then we cede it to the REIT. And you'll notice that we want to maintain at least a 66% stake in the REIT. Right? Why? Because when we ceded that asset into the REIT, what happens? the asset now in the REIT is exempt from income tax, 25%.
Right.
And yet ALI will continue to own about 66% of that of the asset. At the same time, we have the fund management company and the property management company, which collects fees. So almost from an income basis, ALI's whole, even as it has seeded the stabilized asset into the REIT. And at the same time, we get capital back, which we are then able to redeploy and develop more assets.
Yeah, and then
so it's a wonderful business model.
Right, and you have 12,000 hectares of property that you can develop. As you develop, make it earn, and then move to the REIT. You get money,
so even when
develop again.
We don't lose the asset because we'll continue to hold 66%.
Right.
At the same time, we'll earn dividends on the 66%. We also earn on the property management and the fund management fees. So it's almost like from a bottom line standpoint, it's the same before we moved it into REIT. But the additional advantage of moving it into the REIT is that we've got this additional capital that comes back to us and we redeploy it. And hopefully we are able to redeploy it in higher yielding assets.
Galing, Toti. Now I see the fruits of our labor when we were trying to push this law 10 years ago. I see you there in the Senate. Galing, right? I know. Good. Next group of questions. Growth prospects asked by Michelle. Given the post-pandemic situation, what are ALI and AREIT's main drivers of growth? I think you mentioned this asset already, you know. So let's go through the second. How are you going to raise capital amidst the pandemic? You just raised it, Toti, no?
Yeah, same as before, because fortunately we've got access to the debt capital markets, and our bank lines remain intact. So no different from the past. You know, we always have more. I mean, people are very comfortable with our credit rating, and that's why they're willing to give us their capital.
Okay, sige, let's look at the other questions. We still have live questions here. Dividends. Will AREIT's dividend increase this quarter? What is the projected increase of dividend for next year? As by Orla, can you answer that, Carol?
I can't fully disclose, obviously, but if it's any indication, our second quarter dividend this year was 2% higher than the first quarter dividends and 10% higher year on year. And when the Cebu assets are injected, then it can contribute additional increase anywhere between 5 to 6% increase in DPU.
Accretive, as you said. Okay. Toti, may dividend ba mag-increase pa ang dividend? So, sa Ayala land. So I guess the dividends will just get it from AREIT na lang, ano?
Well, from Ayala land to our shareholders, we've managed to maintain the dividends at about 4 billion pesos a year for the past previous 2 years, and then probably about the same amount this year. So for 3 years, we would have been at about 4 billion. Well, as our bottom line grows, then we'll have to think about whether we want to increase the payout. It's an interesting question that we have to discuss in detail within the company, because believe it or not, we actually have investors who ask us, why are you even declaring dividends? Why don't you just redeploy that into the company and continue to grow the business? So what we tell them is it's a good capital management practice, and we also have retail investors who look for dividends. So it's a balancing act on our part.
That's right.
And we firm up that number when we go into our annual planning.
Okay. So good.
But one thing's for sure, we'll continue to declare cash dividends. It's just a question of how much.
Right. But still sustainable. Right. Great. Next, I think we have one more group of questions. ALI or AREIT? This is the usual question when you talk about REITs. Which one will you invest in? ALI or AREIT? What are the reasons why? Anyone wants to answer that?
I'd say
both.
Well,
Carol has said both.
I'd say both.
And I guess
The balance of best of both worlds.
I guess a more nuanced answer, Marvin, would be it depends on your risk return profile. And I'll give you an example. My mother, who's 92 years old, her investment is a REIT.
Oh, nice.
Because she looks for the cash flow. She needs the dividend, the regular dividends. In my case, I'm all in ALI. Because I look at the growth. I haven't retired, so I can take more risk. And the implicit understanding there is higher risk, higher return. So in ALI, I'm looking forward to TSR coming from both, primarily from capital appreciation.
Right. So it really depends on your objective, whether you're looking for cash flow, a REIT, you're looking for...
It's your risk return profile.
Or an ALI. Yeah, great. Sige. So
but for your investors and your clients, Marvin, don't forget, you have ALI, you've got a REIT, and then you've got, if you're really conservative, you have ALI bonds that we issue.
Oh, yeah. Yeah.
Okay. And of course, you can also buy Ayala land residential developments or condominiums. So the whole spectrum, depending on your risk return profile, we have it for you in the Ayala Land Group.
Great. Sige. Salamat. Let's open the for live questions. We still have, I think our analysts have been answering them. I see them answer the questions already live by Richard and Charles. But there might be some questions here that we want to show to the audience. Ladies, do we have such questions that we can ask live here? Yeah. So is there any plan for Ayala to create industrial REIT, other REIT types by Joe Derrick? Any plans for that?
Let me take a stab at that first, Carol. I think, and Marvin, you know the journey to REITs. So we started by helping draft that law. So the long-term plan really is, Ayala Land will develop various asset types, and then once they've stabilized, then you move them into a REIT. So today we have the office REIT, and as you know, we have a pipeline we have other leasing assets, the pipeline, which potentially we could also move into a REIT. So I guess you can see where we're headed. We've started with offices. I think it's just a matter of time before we do a mall REIT or put our malls into a REIT. And then we have our hotels and resorts business, as well as our industrial warehouses.
Yeah. And I understand you also sit as a treasurer in all HC. So yes, I guess.
So as you develop and stabilize these assets, then it makes perfect sense to move them into a REIT.
Yeah.
Now the question that we don't have, that we're still discussing is, do you establish thematic REITs? You establish a separate mall REIT from Carol's office REIT, and then you establish an industrial REIT separately from a mall or an office REIT. We don't have an answer just yet, because the feedback we're getting also is that scale is more important than theme.
Yes.
A big commercial REIT might be better, might create more value and be more attractive to investors than having separate thematic REITs.
Yeah, and you still have a lot of office REITs that you're going to pump into the REIT. So I guess Carol's very busy. She has her hands full. Right. Sige. Next, do we still have questions from the audience? Yan. From Pablo. Aside from property swap, how can REITs acquire more property if 90% of income is given out? You want to answer that?
Well, there's also leverage or debt funded acquisitions. There's also other forms of equity funded acquisitions, such as a follow-on offer, etc. So it's not just through property for share swap.
Yeah. All right. Kaya, they can still borrow pa. Sige, next. We still have more questions. How are you addressing the higher sales cancellation rates for residential? Michael, from Michael, Toti. Malaki pa ba ang cancellations?
It's larger than historical, but it's not something that gives us sleepless nights. How do you address higher sales cancellations? Resell the canceled unit at a higher price.
Pag nag-cancel ba, you get the deposit?
Right. There's a Maceda law. So if the buyer has paid for more than 2 years, then they get half. And the developer keeps the other half.
Then you try selling it again. Yeah. Great. Yeah.
So when you cancel when you cancel a unit, it doesn't the developer still comes away with something, and he retains ownership over the unit, which he can then resell again.
Yeah. Great. Sige. Next. We have more live questions from Jeremy. What would be the future growth drivers for AREIT? You said about 100,000. Is this still in office, or are you going to look at other
asset classes?
Yes.
Yes. Well, for now, the more stable asset class is office, but we're also evaluating, depending on the recovery of certain malls. AREIT is really a commercial REIT, so it can acquire not just offices, but malls and other types of commercial properties. But again, as I mentioned earlier, the growth driver is not just, of course, a big uptick would be from new asset acquisitions, but also there are contracted escalations in place. So that continues to contribute to the organic growth of the company.
Great. Sige. Let's have last 2 questions na lang siguro. Nag-extend na tayo. But thank you for that. But let's get a couple more, and then we've spoken a lot already. So next question by Alex. How do you assess the current government in helping the real estate industry? Toti, how any feedback on that?
Macro answer first would be we're quite pleased with the socioeconomic agenda of BBM because we believe that it will help grow the economy. So as I said, a growing economy is supportive of the real estate industry. Now, in terms of policies that will affect the property industry directly, there are 2. One is part of CREATE. It's a package that the Duterte administration tried to pass previously, and I think they want to get it passed in this administration, which is to standardize the valuation, which leads to the assessment of real property taxes. The objective is laudable for LGUs to be able to raise more funding for their communities by increasing real property taxes. We've noted that not all LGUs have an approach to raise property taxes. So this particular package will help standardize how real property taxes are, how property is valued first and foremost, a uniform valuation standard, supposed to be international standard valuation process. And second, so that they do this on a regular basis. Now, the flip side of that is if it's not worded properly, you might see a severe escalation in property taxes, which affect.
It could be a dampener.
And it's difficult. More than that, Marvin, it might be difficult if you have, say, if you're a landowner with sandwiched between 2 commercial properties and you're assessed at the same level as a commercial property. That could be proved to be onerous. So I think what the industry group, what the industry is suggesting is to do a study on the impact, as well as to put certain provisions in the IRR that will make the this particular CREATE law acceptable or relevant to the community.
Okay, all right.
The second one is a little bit more, maybe we can reserve that for another discussion because it's about the agrarian reform law.
Yeah, that would take a while. So, okay, we'll get one last question and then I'll ask you, Carol first and then Toddy to maybe say a few words or last words to our audience. But let's take this question first and then for your final word as well. With the current situation in the real estate sector of China, are ALI and AREIT have any exposure to this in the near future, asked by Audi? Do you have in China?
Short answer, no.
Mm-hmm.
And thank goodness.
Okay, so, and also no plans yet as of this moment.
No plans.
Okay, great.
And
So,
for
yeah.
REIT also.
No REIT also. All right, sige.
No,
We've taken much of your time already, an hour and a half, but a very good, lively discussion on Ayala Land and AREIT. And thank you very much for the updates. At least the audience and the investors are very much informed about this. And we will be giving them a summary of what we discussed and also a recording of this video. So with that, maybe I'll ask Carol first to say a final word about AREIT and then Toti siguro for ALI.
Again, I just wanted to thank you again for the opportunity, Marvin, and to your clients for your time this afternoon, giving us the opportunity to talk about AREIT and what we've done in the past and our future growth plans. As you can see, we've consistently delivered on not just yield, but on growth of the company, sustaining financial performance despite macroeconomic challenges. And so we hope that I hope that I was able to explain the potential of REIT investing amidst uncertain markets.
Great. Thank you, Carol. Thank you again. We'll have you again once next time. Toti, yes.
We're optimistic about the prospects of the country and the economy of the Philippines, and that gives us reason to be reasonably confident that Ayala Land's growth trajectory will continue into the future.
Great, good trajectory. Thank you very much for this afternoon, Toti. Thank you for the information that you provided us. We'll also see you again next time. Thank you.
Thank you, Marvin.
All right, allow me to conclude this session because the real estate industry was negatively affected by the pandemic, and we saw that explanation on the real estate, residential real estate, and it continues to face challenges, especially with high inflation and high interest rates, as well as the changing office work behavior. And while the share price of Ayala Land and AREIT has so far been affected, what we heard today gives us deeper understanding of how they have faced challenges by reconfiguring and how they are, in a way, rebalancing their portfolios to adapt to the changing times. For ALI, while residential sales weakened, the slack was slowly covered by the commercial industrial sales and leasing, setting them on the path to pre-COVID numbers. Toti explained that it could be in a couple of years. For AREIT, cash dividends were not affected, continues to be accretive, meaning as they pump in new assets, dividends continue to grow. And it continues to grow as they promised since the IPO. So in assessing this investment, for ALI and AREIT, investors must be comfortable with the risks versus the returns that they hope to generate. Potential for capital appreciation is with ALI. And I'm showing here a table of our property analyst estimate, Richard Daneda's fair value estimate of ALI. At current prices, ALI is trading at a discount to its NAV. NAV of 46 pesos per share, and the fair value estimate at 36.80 per share. So at current prices, an upside of about 22% to their fair value estimate of 36.80. We already gave a discount of 20% to to a NAV as more or less a safe discount for this stock. On the next slide, you will see that the historical discount to NAV of Ayala Land is on the 1 standard deviation below its mean. So if you're getting into this stock, you're buying it at a bigger discount to its NAV. So historically speaking, you can see that there may be some value in the stock as of this moment as well. For dividends, check out AREIT. Dividend yield as shown in this REIT snapshot. We come up with this snapshot, or this is available in our website. We always compare the REITs compared to each other as far as their price, estimated dividend per share, yield, and also the growth of the share price in terms of the share price from the offer price. As you can see, while AREIT has given you a lesser dividend yield, but still decent at about 5.5%, but it gave you the best return from its IPO at 37%. So that's a snapshot that we provide our investors as well. You can look it up in our website. So for AREIT, you have both dividend as well as the potential for capital appreciation. Okay, so as a reminder, review your portfolio, allocate appropriately depending on your objectives, whether it's capital appreciation or dividends. Match it based on your goals. As our country recovers, companies with good fundamentals will recover as well. As a disclaimer, again, we are having these companies in this conversation, not as an endorsement or recommendation, but we do this for investors to have a deeper understanding and better appreciation of the businesses and to know more about the people behind for a more informed decision.